This is Bloomberg Daybreak Middle East Africa, our top stories this morning. Asian shares get a boost from the rebound on Wall Street as investors turn optimistic on big tech earnings. Tesla, though, first up on the docket. Shares there have slid 7 days in a row now with a gloomy forecast. And an external report finds that Israel has yet to provide evidence that UN workers in the Gaza Strip have ties to terrorist groups. It's just gone 8 a.m. across the Emirates. I'm Vonnie Quinn in Dubai, and let's see how we are shaping up this Tuesday session. We did see a bit of a rebound in the Monday session, and indeed, futures don't really know what to do with themselves. We do get 40% of the S&P 500's market cap reporting this week with a big kickoff today, Tesla, PepsiCo, among others. So we'll see how that market opens. Certainly across Asia, we are seeing a rebound. Brent crude is holding steady around the $87+ mark, but gold, interestingly, is giving up more gains. It's been flirting with the $2,300 mark for some time now. Interestingly, we have a bifurcated view out of the US. We have Mike Wilson, the Uber bear, on the one hand, who says that, the outlook is maybe a little bit more rosy for profit growth. Marko Kolanovic from JP Morgan, though, saying there are so many red flags. Trade defensively in this market. And indeed, let's have a look at this chart because it does show us how tech valuations have come down. They are still above their 5-year average. But look at this. The performance for big tech, it's at the worst now since back in 2009. All right, let's check in on that rebound across Asia now. Avril Hong is in our Singapore studio. Avril.
Yeah, Vonnie, we're seeing that rebound actually lose a bit of steam. The Nikkei and the Kospi in the green, but not by much. You get the sense that they're on wait and watch mode for big tech earnings. In the Hang Seng, we're seeing the tech sector really powering the gains. It is outperforming in the region. And in the meantime, we have the likes of UBS upgrading their call on China and Hong Kong stocks. And it's doing this by, going to fund this by downgrading its call on South Korea and Taiwan stocks. So that's what we're seeing on some of these house calls. But flip the board, we want to take a look at what we're seeing on the yen as well. As the Nikkei climbs about 0.2%, I have to say that it has been fluctuating for much of the session after the finance minister's comments, that verbal intervention to keep the yen weakness in check. It did hit that 154.85 level, weakest against the greenback since June 1990 earlier on. And it has seemed to steady a little bit as the session progresses, coming from those comments from the finance minister, Vonnie.
Avril, thank you so much. We'll keep an eye out. That is Avril Hong in our Singapore studio. Well, US stocks then rebounding after that sell-off, with investors hoping big tech will meet lofty expectations during the busiest week of the earnings season. Garfield Reynolds leads our Markets Live Asia coverage and joins us now. Garfield, it may be the busiest, but is it the most important week of earnings season? After all, we don't get Nvidia for another month nearly.
Yeah, well, I think even without getting Nvidia for another month, this is a very important earnings week in the season because we do get a significant amount of the Magnificent Seven reporting. And I think in particular, we've got Tesla, but that's whatever Tesla does perhaps has less of an influence than had been the case. But Meta, for example, these are it's among the stocks that really matters, and these are the companies who are seen as delivering very, very strong profit gains, and profit gains that can signal that the rest of the corporate universe in the US can feel surer about decent profits going forward because they're leading the charge on AI. So with that being the case, those are very important. A couple of weeks ago, there was a lot of apprehension about, can the rally that we were seeing at that stage maintain its breakneck pace? After the last week or so, when we had a pullback, perhaps now the bar is a little bit lower, and a decent set of earnings could be enough to spark a fresh rally now that investors have are facing slightly cheaper stocks than they were.
Garfield, is everything normal about this market? I don't remember a time when we've seen such outside moves after earnings, than now. It seems so emphasized now. So we got United the other day and there was a 17.5% move, and Nvidia on Friday with a 10% move lower. I mean, is that normal?
Well, I think it speaks to the very difficult to read situation that investors find themselves in. It's the same as, the equivalent, as it were, for government bonds of an earnings report is an economic report which has an impact on where the Fed is going to move rates. So we've seen some extraordinary moves in yields. The 10-year yield moved by the most in about 2 or 3 years the other week in response to an inflation print. That's the sort of thing, that's going on in bonds, and it's going on in stocks as well, because there are so many unknown factors. And I mentioned before about people wondering, can the rally continue? And that feeds, that's got a feedback loop there with, can what's been going on in the bond market continue? Does the Fed keep rates high? Because does the US economy go on being resilient? And if the US economy goes on being resilient, well, that means profits should remain resilient. But then the question comes back to how high do bond yields stay? Because if bond yields are high, then the valuation part of the equation becomes very tough. So you've got so many moving parts in there. That helps to explain why a relatively small shift in the earnings outlook can set off a big move in particular stocks.
Garfield, thank you so much. That is Garfield Reynolds from our Markets Live Asia team. Let's continue this discussion now with Dan Farley, State Street Global Advisors Investment Solutions Group CIO, who joins me in studio. So, Dan, that was a long list of elements that we have to consider in order to decide what's the correct valuation on a stock. How are you doing it?
Well, I think at this point in a market cycle, it's incredibly difficult. I mean, you asked the question, have we ever seen anything like this before? And I think that perhaps the size of the moves are a bit outstated. But the reality is that there is, at this inflection point, whether that be uncertainty about what the Fed's going to do from themselves, right, uncertainty around where these earnings are going to come in, and I think that the growth rate that supports that are all at these change points, and when that happens, you're going to see volatility around that. So what I don't think is unusual is that we're seeing the vol that we've got right now. It's perhaps the size of it, and particularly in fixed income, as Garfield noted. Yeah, exactly.
Well, I sometimes feel like we're in the upside down, and not just for that reason, but also for the reason that, we're seeing strategists change their minds. So Mike Wilson has suddenly said, we could see profit growth to meet expectations if the economy continues to be resilient. Marko Kolanovic, though, continues to say, look, too many red flags. They see, JP Morgan sees the S&P 500 at 4,200 at the end of the year. What's your call?
So I think they both can be right.
Yeah.
In the sense that in the near term, the U.S. economy and the global economy, for that matter, is still reasonably strong. And so we think that here in the next couple of quarters, earnings can probably deliver, and they probably need to deliver in order to support the valuations that we've seen, even with the pullback. I think our concern is, as we look a bit farther out, that there's plenty of red flags. We had been overweight equities for a very long time. We still are modestly. But as we've started to see some deterioration in that macro outlook, if we've seen the deterioration in investor sentiment that used to be very positive for stocks and a little bit less so now, all of those things have said to us, we still want to tilt to stocks, but we've pulled that back pretty significantly.
What about the Magnificent Seven? That's been the only player. Investors turning against the Mag 7 now?
Well, I think that we've seen from a results perspective that the Mag 7 is becoming the Mag 5. So that's part of it. And I think what we have to see in this earnings period here is that spread and that breadth, because if that doesn't happen, then we're going to be in a market that's probably a bit more vulnerable. I would say, though, as much as we've seen the movement in the stocks, and they have been outsized in many of those 7 companies, when you look at the valuations that they have relative to the growth, they've delivered, right? NVIDIA is the poster child for big moves, but they have continued to deliver on the earnings piece of it. And so, obviously the concentration is a concern, but the fact that it is being followed up with companies coming through with that, need to moderate the concern.
You can't fault that, right? Exactly. Now, you still see 3 to 4 cuts this year. How do we get 3 to 4 cuts with the economy holding up so well?
So I think that there's a piece in that, Vonnie, that's a question of what are they probably going to do versus what we think that they should do. Right? So market's pricing in 2 cuts. We think that maybe we get to 3. But we do think that what happens if that is the numbers that we get to is that the Fed is actually going to put themselves a bit in the corner. If we look at what's happening between CPI, a year ago this time it was up close to 4.8, it's down closer to 3.8 today. Fed funds still 5.5 in both of those situations. Core PCE has come down quite precipitously. We just think the Fed's very restrictive right now. And if they delay as markets and economies start to slow, that's going to put them in a very difficult position. Probably not so much in 2024. Our call is not recession in 24, but potentially in 25. And if they get too far behind the curve, what could have been a short and shallow recession turns into something a bit deeper.
How come economic strength is holding up so well? I mean, it's been more than 2 years now since the Fed started to move.
Yeah. So I think that there's been a couple pieces to that. One, from a corporate perspective, companies did a really good job of shoring up their balance sheets and their income statements. They refinanced their loans 2 years ago when rates were low. So I don't think that they have fully felt the impact of the Feds raising their rates. And so that has helped drive some of the profitability that we've seen. It's helped allow them to be a bit more resilient. I also think that when you look at what we've seen in employment, that has continued to be strong. And so all of those things have kept the consumer in a pretty good position. I would say, though, that if you start to look at some of that data, you start to see some cracks there. Right? So the mix between full-time and part-time employment is starting to see much bigger growth in part-time. Average hourly earnings, hours worked, right? Job openings are being cut, which are basically stealth layoffs. Right? All of those things, I think, from our perspective, back to your point about red flags and warning signs, those would be in that camp.
Now, you mentioned that you're less overweight U.S. equities. You're also overweight cash at the moment, but you like high yield still, which I think is interesting. And also, I want to examine your call on gold, which is also overweight, even though we're seeing gold come off the boil now.
Right. So high yield is admittedly an interesting one.
Yeah.
I think part of that has been driven by the fact that, again, the environment has been pretty good for risk assets. Ours is not a call that we think spreads are going to tighten much from here. In fact, that is a concerning part of this call. However, given where we are from a growth point of view, not really concerned about defaults as much, and the fact that the carry you get on high yield relative to other pockets of fixed income, we'd rather clip that coupon, and we think that's a way for investors here in the near term to add to return. On the gold side, that has very much been largely a technical call for us, and so admittedly the last couple of days have been a bit more challenging for gold, but we do think that there has been enough of that will continue. Interestingly, you've also seen such incredible amounts of buying from central banks around the world, right? And almost 2 tons in the last 2 years. And so while that perhaps starts to come off and may take some of the bid away, we do think it puts a bit of a floor there because those tend to be more permanent holdings that can support it as well.
All right, Dan, we have to leave it there, but thank you so much. Fantastic context as we head into a huge earnings week. Dan Farley there in our Dubai studio, Investment Solutions at State Street Global Advisors. He's the CIO of that unit. Still ahead, oil markets looking relatively muted as the threat of a full-blown regional war eases in the Middle East. Crystal Energy shares their outlook for crude. That's later in the hour. But first, investigators say Israel has not provided any evidence to back up claims that many UN staff in Gaza are members of terrorist groups. We'll have details next. This is Bloomberg. Welcome back to Bloomberg Daybreak Middle East and Africa. I'm Vonnie Quinn in Dubai. The European Union has agreed to impose new sanctions on Iran over its attack on Israel. The deal will further expand restrictions already imposed for supplying Russia with drones. The measure also targets weapons transfers to Iranian proxies in the Middle East, including Hezbollah. Countries including Germany and Sweden are pushing to add Iran's Islamic Revolutionary Guard Corps to the EU's terrorism list. Meantime, investigators say Israel has yet to provide evidence that workers for the UN relief agency in Gaza have widespread ties to terrorist groups. A UN-commissioned inquiry did not come to any conclusions on Israeli claims that as many as 10% of the relief agency's workers were members of Hamas or of Islamic Jihad. For more, let's bring in Bloomberg's Paul Wallace. So, Paul, what exactly does the UN-commissioned report say?
Well, firstly, this report is, by the UN's own admission, it's not that conclusive. It was carried out by a former French foreign minister. But what the report does try to do is rebuff this idea that the relief agency known as UNRWA had widespread links to militants, including Hamas and Islamic Jihad, in the years running up to October the 7th. And it says that Israel is yet to present evidence of that, or that up to 10% of UNRWA staff were involved in October the 7th. It was obviously a huge claim by Israel when it said that a few months ago. The UN and UNRWA were keen to dispel that. There is a separate investigation going on by the UN itself, looking into these allegations more deeply. But so far, according to this report at least, Israel is yet to come up with any firm evidence showing, backing up its claims.
What does it mean for humanitarian assistance in Gaza? We know that as much as 50% of the population is at risk or in famine right now.
Well, we knew that tensions between UNRWA and Israel were dire almost as soon as October the 7th happened, and even before Israel came out with these allegations. Israel has pretty much rejected this report already. It said it wasn't a thorough enough investigation and not the kind of probe that it expected to see. In terms of aid going into Gaza, there is still obviously huge pressure from the outside world for Israel to do more to allow more aid in. Israel is sticking to its long-held line that the problem is not getting aid into Gaza; it's the distribution of it once it's there. But this report, I think, will, if anything, just increase tensions between UNRWA, which is the biggest aid distribution agency in Gaza, and the Israeli government.
Shifting topics very slightly, so the US is likely to impose sanctions on this Orthodox battalion of the IDF. What does that mean for relations with the United States and Israel?
I think if the US goes ahead with it, and it's said that it will make some kind of announcement within days, that would be a pretty major step. This would be the first time that the US has directly targeted a unit of the Israel Defense Forces with sanctions. We've already seen pretty much an uproar within Israel against this. Prime Minister Benjamin Netanyahu says he's going to fight this any way he can. Benny Gantz, who is a rival to Netanyahu but a member of the war cabinet at the moment, he's pretty much said the same thing. So I think if this does go ahead, it's going to cause a lot of strains within the US. I think also important to note there could be a split within the US. Some Republicans have already come out and said that the White House cannot do this to an ally as important as Israel, especially now of all times.
Well, we'll await any official announcement. Paul, thank you so much for all the context this morning. That is Bloomberg's Paul Wallace. Up next, Tesla in chaos. We look into issues the tech major is facing as it reports first quarter earnings this evening. This is Bloomberg. Welcome back to Bloomberg Daybreak Middle East and Africa. I'm Vonnie Quinn in Dubai. Let's turn now to earnings. Tesla reports tonight, and it's not looking pretty, especially considering deliveries for the first quarter already missed estimates by the most ever. And as the EV giant deals with a myriad of issues, shares have slid more than 40% year to date. For more, Robert Leap, our senior analyst with Bloomberg Intelligence, joins us. So, Robert, a good portion of that 42% drop or so has come in the last several sessions. What is the market expecting from tonight's results?
Yeah, OK, thanks, Vonnie. I think you already mentioned some of the details in your intro there. I mean, you just need to look at the share price. The market is expecting a weaker set of numbers. But just to throw a few of those at you, in adjusted EBITDA terms, so that's like a cash-adjusted operating profit measure, the markets or consensus is looking for that to fall 8% quarter over quarter, and for that measure to be down 15% or so year over year. But as you said, the production numbers came in weaker. The sales number, which are pre-announced, also came in weaker. So the market, the market is set up for weak results, and more importantly, given the market looks ahead, probably weak guidance.
What are main risks, I mean, beyond what you've just outlined, that Tesla faces right now?
Okay, I'm afraid for Elon Musk and a company's point of view, there's a multitude of risks at the moment. Obviously, I think most people agree the shift towards EVs is a longer-term structural trend, but at the end of the day, EVs are priced at a premium to mainstream cars or automotives. So in a slowing economic environment, there's that type of pressure, which is resulting in a slowdown in demand globally, not just for Tesla. But at the same time, on a competitive front, the volume players are moving in, particularly the Chinese, and arguably beginning to eat Tesla's lunch. So that initial market leadership they have is being eroded to some extent. As BYD and others, gain share with the support of the state, the weight of the state behind them, aggressively taking share. And you may have seen news earlier this week. Tesla's cut prices. They just followed suit. So we're in the early stages, arguably, of a price war on the EV side, with a backdrop of slowing demand. So it's going to be quite tough for them for the remaining quarters and arguably beyond that.
Yeah, so briefly, Robert, are Tesla's challenges more short-term then or long-term too?
There are definitely short-term challenges, but again, I think, the mainstream automakers are moving in. One huge advantage they have versus Tesla, they have a cash-generative, mainstream, gasoline-based car base, which is highly cash-generative and underpins their investments and underpins their earnings. Tesla doesn't have that advantage. So that's one structural disadvantage it has at the same time when these big volume players and aggressive volume players from China are moving in. So yes, whilst the long-term outlook in EVs looks good, I think it will remain challenged for Tesla for some time.
Robert, thank you so much. That is Robert Lee, our senior analyst for Bloomberg Intelligence, and we are awaiting those results with great anticipation. Let's have a look at how the Middle East fared in yesterday's session. We had Abu Dhabi back open, the general index down for a second day. It was down 0.6%, the lowest closing level in at least a year. And as you can see, it was pretty much down across the board. ADX general, as I just mentioned, down more than 0.5%. The Tadawul was down fractionally after 2 days of small gains. Al Rajhi Bank contributing most to that decline there. As you can see, Qatar down 1.3%. That's a third day of declines now. Qatar National Bank contributed most to that decline. Israel, of course, was closed for the Passover holiday, but the TA35 had risen 1.1% on Sunday. Do stay with us. You're watching Bloomberg Daybreak Middle East and Africa. This is Bloomberg Daybreak Middle East and Africa. Our top stories this morning. Asian shares get a boost from the rebound on Wall Street as investors turn optimistic on big tech earnings. Tesla, though, first out of the gate. Shares have slid 7 days in a row now with that gloomy forecast. And an external report finds that Israel has yet to provide evidence that UN workers in the Gaza Strip have ties to terrorist groups. It's just gone 8:30 a.m. across the Emirates. I'm Vonnie Quinn in Dubai. Let's see how we are shaping up for the Tuesday session. So it looks like futures are maybe pointed lower, but they're a little undecided, honestly. They were a little higher earlier on as well, and we are seeing an update across Asia. We also saw an update in the United States on Monday with the S&P 500 back above the $5,100 mark now, or the 5,100 point mark. We also saw the NASDAQ 100 rising 1%. A big relief to those who saw that massive chip and also AI sell-off on Friday. Remember, NVIDIA was down 10% Friday session. Well, it was back up about 4.25% or so, so retracing some of those declines. We do still have, though, very mixed messages on this market, and particularly this earnings season. Mike Wilson of Morgan Stanley, remember, used to be an Uber bear. He says, look, with the economy so resilient, profit growth can hold up, and he's anticipating quite a rosy set of earnings this season. But then we have Morgan Stanley saying that on the one hand, JP Morgan on the other saying, no, there are red flags all over the place, particularly Marko Kolanovic, the quant at JP Morgan. He sees 4,200 by the end of the year for the S&P 500. That would imply a 16% downside from where we are at right now. So very, very mixed feelings out there. Have a look at this chart. It's Tesla. It's not Tesla. It is the big tech performance being the worst it's been since 2009. Let's move on now to Asia and see how we are faring in Asia. Avril Hong is in our Singapore studio.
Yeah, Vonnie, we're seeing a bit of a mixed picture. A slight bounce, though the CSI 300 has been negative for much of the session. The Hang Seng is leading the way, and you get the sense that sentiment towards Chinese stocks, that's improving. We have the likes of UBS, for example, upgrading Chinese as well as Hong Kong stocks from neutral to overweight, and they say that earnings have been resilient. That's despite what we're seeing on the property sector and those macroeconomic woes. The Nikkei has been pairing gains from earlier on in the session following those comments from the finance minister talking about possible yen intervention. Let's flip the board, because we also got comments from the BOJ governor today speaking in parliament, and he seemed to have comments that also were geared towards curbing yen weakness, saying that they could still raise rates if underlying inflation goes towards that 2% BOJ target. That's raising speculation. We could see another hike from the central bank later in the year, and we saw the yield on the 5-year hitting levels we haven't seen since 2011 at one point, Vonnie.
Avril, thank you so much. That is Avril Hong there in Singapore. Well, oil is taking higher this morning as traders weigh easing Middle East tensions. Futures coming off a back-to-back weekly loss, but remain higher this year due to geopolitical risks and OPEC plus supply cuts that have tightened the market. Let's bring in Carol Nachle, the CEO of Crystal Energy. So, Carol, thanks for joining. We did see that risk premium come way off the barrel of Brent there. We're down from 91 to 86 the other day, but we're back up now, ticking higher inch by inch. What is this oil market telling us?
Good morning. First of all, definitely, geopolitics is on everybody's mind when talking about oil markets, because even though the tensions now have eased a bit in the Middle East, they have not dissipated. You still have ongoing war in Gaza. Red Sea is still not stable and safe. Ongoing war in Ukraine, sanctions on Iran. So really the geopolitical developments and pressure on oil markets are still there, cannot be ignored. But there is a difference between them making a huge impact on prices or having a dampened effect. And that dampened effect today is coming from several factors that are still at work in the market, primarily the spare capacity of OPEC Plus, which has added a lot of safety cushion. And usually we look at spare capacity when we are also assessing the geopolitical risk premium. So the higher that capacity, the lower the geopolitical risk premium. There is also demand. A few weeks ago, everybody was talking about central banks perhaps reaching the time where they would start cutting interest rate. But we are seeing maybe a setback in that story because of inflation remaining persistent. And that is making people more focused on the macroeconomic outlook. China, positive sign, but great uncertainty remains about the outlook of China, and non-OPEC supply remains strong. So on balance, this is what I think the cocktail of these forces is giving us the oil prices that we are seeing today.
Yeah, it's fascinating. And then, Carol, we've been talking about big tech earnings and how we're, about to hit peak earnings season. But what about the energy companies? Are they benefiting from these higher oil prices, or is the volatility also hurting them?
Well, volatility definitely benefits trading arms. So companies with established trading arms would welcome volatility. But overall, if I look at oil prices, because that's what really drives the profitability and the earnings of major energy companies around the world, as well as gas prices, depending on how established their gas business is. We are expecting, because we saw softening in prices in the first quarter of this year, relatively speaking to previous periods, that probably earnings of major oil companies are likely to take a hit, but it's not going to be a drama. Prices are still above in the high 80s, mid 80s to high 80s. Then I'm not expecting a big drama, but maybe a softening compared to previous periods, given the trend in prices.
Carol, when it comes to OPEC Plus, we obviously have the June meeting coming up, and I guess we're anticipating that they'll prolong those supply curbs. Is there any chance that OPEC Plus will decide to actually increase them?
Look, a lot can happen between now and June, and OPEC Plus is focused on the demand outlook. Maybe a few weeks ago, when prices started climbing consistently, and they hit 90 and above 90 for Brent, there were more talks about actually the possibility of starting unwinding the cuts and starting with the voluntary cuts to start gradually putting more barrels in the market. But it all depends on the demand outlook, how strong the demand is going to be, bearing in mind that OPEC is the most bullish in terms of its forecast for demand growth this year. I mean, there is more than 1 million barrels a day difference between OPEC and other estimates, primarily the International Energy Agency. So I don't see further cutting, but there is two questions here, either starting to unwind the voluntary cuts gradually or sustaining those cuts. And mind you, many forecasting agencies have incorporated an extension of those cuts for the second half of this year, and that by itself would justify a slight deficit in the market. Putting more barrels in the market under existing conditions, and especially if demand does not turn to be as bullish as OPEC is forecasting, can tilt the market into a surplus and put downward pressure on prices.
Carol, the natural gas market in the US has been extraordinarily weak. Not so much Europe, although we have seen a lot of volatility in Europe and in Dutch futures and so on. What do you anticipate the outlook is for natural gas? Given the backdrop of oil, they don't seem to sort of pair up at all, do they, these two markets?
And it's amazing what has been happening to gas, because don't forget that just less than 2 years ago, I mean, we saw prices skyrocketing, especially in Europe and everywhere else, upward pressure on prices. And today, all that seems to be long gone in the memory of many. But gas prices, yes, you're right that they are developing a mind on their own because of the development of LNG, more trade happening, and also the markets that used to be disconnected in the past, let's say Asia and Europe and North America, now are influencing each other. So that's why we also keep an eye on what's happening in Asia, what is happening with the demand in China, because China is a massive buyer of LNG in particular, and that could affect gas prices. But so far, they are not as exciting as oil prices, and they seem to have gone into different territory, because also if you look at the European market, storage is full, demand destruction because of high prices, a lot of supply that has come. And as I said, Asia is not really booming. So that's why we see this kind of disconnect, because gas markets have evolved and they have come a long way from, let's say, 20 years ago when they were closely following oil markets.
Yeah, we're just having a look at stockpiles there. It seems that there's no change in sight, at least when it comes to supply, but there's a La Nina coming. Carol, what is the market saying about the potential impact of a La Nina following the El Nino we've just had?
Sorry, say that again. I missed the last one, the last part.
The La Nina weather pattern, is it likely to have an impact, the La Nina weather pattern that we're about to see?
Yeah, I mean, absolutely. It depends on how much disruption that is going to go to cause in terms of production. But again, I'm not terribly worried, because, as I said, I mean, there's safety cushion in the market, and that could dampen. It depends. It's never one single factor in oil markets. It'd be a mistake to zoom in on a single factor. There are several forces at work, and we have to see, is the market really in tight situation? Is there sufficient spare capacity? Is the demand booming? Is the supply struggling? So all these we have to take into consideration to assess the impact. But usually weather disruptions can cause supply disruption. But again, it's not a major drama, depending on how much actually disruption they can cause.
Love it. No major drama ahead. Carol, thank you so much for all your time this morning. That is Carol Nachley, the CEO of Crystal Energy. Coming up, after months of wrangling in the United Kingdom Parliament, Rishi Sunak's flagship Rwanda deportation bill set to become law. We're live in Rwanda's capital, Kigali, next. This is Bloomberg. Welcome back to Bloomberg Daybreak Middle East and Africa. I'm Vonnie Quinn in Dubai. The UK Prime Minister's flagship bill allowing asylum seekers to be sent to Rwanda is set to become law after months of wrangling. Rishi Sunak's government is preparing to get the first deportation flights off the ground by July after the House of Lords dropped its opposition to the plan. Let's bring in Ondiro Oganga now, who is in Kigali. Ondiro, how ready is Rwanda to receive migrants?
That's a great question, Vonnie, because a couple of things have been made to get ready for this occasion, one of them being housing. And the government spokesperson, Yolande Makolo, says it's not Babyland, but it's feasible because there is a hostel, one of them being Hope Hostel, that has a bed, a mosquito net, a pool table, and there are other hostels that are on standby awaiting a contractual agreement once Rwanda is certain that these asylum seekers are going to come here. Another area that they're working on and preparing is jobs and opportunities. The government says they will be trying to integrate them into the Rwandan society by teaching them Kinyarwanda, the national language, and also job skills so that they can invest in them and turn them into assets for the Rwandan government, deterring them from making these dangerous journeys. However, this whole process is not without skepticism. If you listen to Victoria Ingabire, who's an opposition leader in Rwanda, she says that the good life that these asylum seekers are looking for is not waiting for them in Rwanda. UK is a democratic country, Rwanda is not, and it's a place with very few resources, a literally poor country that has very little to offer them. So this process for the UK is a deterrence for Rwanda. They think it's a new leaf for these asylum seekers, but some of the refugees that have been hosted here before say that given an opportunity, they'll still take a shot at trying to make it to Europe or the UK.
So it does seem like there are many doubts on the suitability of Rwanda for migrants, you know, on behalf of the migrants, but also on behalf of Rwanda, the country.
Yes, and a lot of doubts will be cast and have been cast on Rwanda throughout this process. If the first flights take off, then Rwanda's judicial and legal system will come back into scrutiny again. And I think Prime Minister Rishi Sunak addressed this yesterday in his address, where he said Rwanda has made the necessary changes in their system to accommodate the legal needs of asylum seekers fairly and squarely. And despite all the criticism that it has attracted during this process, the Foreign Affairs Ministry says that it's unwarranted because what Rwanda has done is step up to the situation. We've seen President Paul Kagame also stand up and say that if the asylum seekers do not make it to Rwanda, the money will be given back. So now Prime Minister Sunak is between a rock and a hard place. 2 years on, £220 million invested, no flight has taken off. And so Rwanda is what could soften an otherwise hard blow as the Tories head to the general elections. To the local elections, rather.
Yeah, for sure. Yeah, exactly. Ondiro, I want to just move now to another big story in the region. Africa's largest early-stage venture capital fund. Tell us a little bit about what's going on with them.
TLCom Capital has raised about $154 million from investors such as European Investment Bank, Visa Foundation, and Allianz SC. And this money is going to be used to expand into countries like Egypt, but also put in startups that are addressing local challenges in Africa by providing homegrown, innovative solutions. Already they've put some money in Egypt in Middle Mile Logistics Company, South African e-commerce company, and they're also looking to put some money in female-founded startups. And this is very important because last year was a really hard year for startups. Inflows dried by about 31%, dropping them to about $4.5 billion. And we saw the ripple effect of this. Some companies had to shut down shop and others had to contend with mass layoffs such as Paystack.
Ondiro, can't wait to hear more about this as time goes on. That's Ondiro Oganga there in Kigali for us. Thank you. And South Africa's elections will be the focus of our next Africa Amplified show. Don't miss that. That's Friday, May 3rd, right here on Bloomberg TV. Plenty more still ahead. Do stay with us. This is Bloomberg Middle East and Africa. Welcome back to Bloomberg Daybreak Middle East and Africa. I'm Vonnie Quinn in Dubai. Let's get to some other stories we're watching this morning. The U.S. Federal Trade Commission is seeking to stop an $8.5 billion merger between two fashion giants. The agency filed complaints alleging that the deal between Coach parent company Tapestry and Michael Kors owner Capri would harm the luxury goods market. It's the first time the Biden administration has used its aggressive antitrust enforcement to try to stop a deal in that sector. Valentino's chairman says Chinese demand is still weak and that conditions remain tough for luxury goods. The country's weakening consumer sentiment has hit other global luxury brands. Both LVMH and Kering have also seen slumping mainland sales.
This year started with an expectation that the luxury markets will grow between 2 to 4%. My personal feeling, it will be much less than that. Probably it will be flat. The reality is that Europe, US is still very flat at the moment, and China is still weak. And we have already seen some companies coming with some results. And it is very clear that it is quite a challenging environment in 2024.
Meanwhile, turning to geopolitics, President Biden has told his Ukrainian counterpart the U.S. will move quickly to deliver weapons if the Senate votes this week to approve an aid package. In a phone call, Biden told Volodymyr Zelensky the U.S. aims to swiftly ship the battlefield and air defense equipment. The president of the European Investment Bank, Nadia Calvino, called the U.S. funding approved by the House of Representatives very valuable. She also expressed unwavering support for Ukraine.
I think it was a very productive spring meetings week. We had many exchanges, and I really see a momentum in coming together and supporting Ukraine very strongly, but also deepening our cooperation within the multilateral development bank family to contribute to climate change financing, peaceful and a more, how would I say, sustainable world going forward.
We'll get some more details on your lending plans in just a moment. There has been a sense of fatigue in Congress around what is happening with Ukraine in its war, its fight against Russia. There are some people asking whether there is a different way, whether this should be something we continue with, stick with, continue funding what looks like maybe a never-ending war. What would your view on that argument be?
Well, absolutely. We need to support Ukraine. It is a very serious situation that we're living. It's a threat to democracy at the end of the day, and the way we see things, I think, in the US and Europe too. And so from the European point of view, there's no doubt our support to Ukraine is unwavering. I think the decision that has been taken by the US to provide support for more than $60 billion is very valuable. And this joins also the previous decision of the European institutions to provide 50 billion euros in the Ukraine facility, which we will manage at the European Investment Bank. And I think it will provide much valuable support for the reconstruction as well as the military effort, of course.
But, President, did you see the vote counts on those aid bills? So when you look at something like the Indo-Pacific, it was 385 to 234 in the House. When it comes to Israel, it was 311 to 112. It barely got through when it came, to Ukraine. Right. How concerned are you about how deeply divided U.S. politicians are about aiding Ukraine over, say, other issues like Israel and Taiwan?
I really think that we should continue to support Ukraine. As President Zelensky was just saying on the screen, they have a chance if we continue to support them. From the European point of view, you know, Ukraine is our neighbor. It is a prospective member of the family, if I can say it this way. And thus, we need to ensure that we keep a secure environment in the region. The other conflicts are just as important. I mean, the Middle East situation is very worrying. It's a source of concern for all of us. And we should try to stop that war and that conflict, you know, as soon as possible. But Ukraine should not be forgotten.
President of the European Investment Bank there, Nadia Calvino, speaking with us. Let's take a look at how we're shaping up now for the equity trading day ahead. If we look at futures, it looks like we're pointed lower because we see a little bit of red. But honestly, we had an up day yesterday and we've had an up day across Asia so far. Also, Euro stocks futures look to be pointed higher. So I wouldn't be wedded to that down mark for the S&P, NASDAQ and Dow Jones futures. After all, the S&P was back above 5,100 in the Monday session, which was very cheering to those looking for earnings season to also give a little bit of a lift to the market, which saw a downdraft last week. Of course, it was 6 straight sessions of down movement for the S&P 500. So again, we're back above 5,100. There are plenty of earnings this week. 180 companies or thereabouts reporting in the United States. The vast majority of the Mag 7 will be reporting, and so a lot to look forward to. Let's move to Treasuries now, because we had seen a huge movement in Treasuries, but with no Fed speak and just supply, that's what is affecting the Treasury market this week. The amount of supply and the appetite that we'll see for that supply. So the 2-year yield back below 5% by about 3+ basis points. The 10-year yield 460.85. When it comes to commodities, we're really focused on oil and gold, of course. Gold giving up more gains. It's trading around the $2,300 mark now. And as you can see, Brent crude, it is above $87 a barrel. So it is putting on just a few more cents, but we're well below where we were at the top of that risk premium period when we were at about $91 a barrel there on crude. So do stay with us. We are headed into the European trading day. Tom McKenzie is going to bring you all of that with Daybreak Europe coming up next. And we'll be back with you tomorrow. This is Bloomberg Middle East and Africa.